I need to warn you about something that's been keeping me up at night. It's a financial shift on the horizon, one that could truly devastate your savings. And I'm not exaggerating. The Federal Reserve is poised to make moves that will punish those of us sitting on cash. If you don't act before they do, you might regret it for years. I'm the last person to tell you that holding cash is always a bad idea. At Berkshire Hathaway, I've held record amounts, over $300 billion at last count. Cash is wonderful. It gives you options and lets you pounce when opportunities arise. I've built my career on having cash available when others were desperate. But there's a critical difference between holding cash strategically and holding it ignorantly, between having dry powder ready to deploy and letting your savings sit idle while inflation eats them alive. Millions of Americans are making a catastrophic mistake with their cash right now. They believe they are being safe and conservative, protecting themselves from market volatility. But in reality, they are guaranteeing a loss of purchasing power every single year. Let me explain what's happening and why the Federal Reserve's next moves will accelerate the destruction of cash savings. For the past few years, savers have enjoyed something they hadn't seen in over a decade: high interest rates on savings accounts and money market funds. Parking your money in a high-yield savings account, earning 4 or 5% with zero risk, felt good and safe. After years of earning essentially nothing, people finally felt rewarded for their prudence. But here's what most people don't understand. Even at 5% interest, you're losing money in real terms if inflation is higher. And even when inflation comes down to 2 or 3% and the Fed cuts rates back to normal, your after-tax return on cash will barely keep pace with inflation. In many cases, it will fall behind. Let's look at the math. Say you have $100,000 in a savings account earning 5%. That sounds great, $5,000 a year in interest. But then you pay taxes on that interest. If you're in the 24% federal tax bracket and live in a state with income taxes, you might pay 30% or more on that interest income. So your $5,000 becomes $3,500 after taxes, a 3.5% real return. Now factor in inflation. If inflation is running at 3%, your real purchasing power increase is only 0.5%. Your $100,000 grew to $100,500 in nominal terms, but it only buys you about $500 more in goods and services than it did a year ago. You worked all year, deferred consumption, and saved diligently, and your reward is $500 of additional purchasing power. That's pathetic. But here's where things get really dangerous. The Federal Reserve is signaling that they will cut interest rates. When they do, that 5% yield on your savings account is going to disappear. It might drop to 4%, then 3%, then 2%. Suddenly, that barely positive real return becomes a negative one. And here's what I want you to understand. By the time rate cuts are obvious to everyone, the opportunity to reposition your portfolio will have passed. Asset prices adjust in anticipation of rate cuts, not in response to them. The stock market moves first, then the Fed acts. If you wait until after the Fed cuts rates to get out of cash, you will have missed the move. Let me share some history with you because this pattern has repeated itself many times over my investing career. In 2001, the Federal Reserve started cutting interest rates aggressively in response to the dot-com bust and recession. They cut rates from 6.5% all the way down to 1% over the following years. Investors who were sitting in cash at the start of that cutting cycle saw their yields collapse. Meanwhile, investors who had positioned in stocks and bonds before the cuts captured enormous gains as asset prices rose. The same thing happened in 2008 and 2009. The Fed slashed rates to zero in response to the financial crisis. Savers were devastated. For more than a decade, you earned essentially nothing on cash. Meanwhile, the stock market went on one of the longest bull runs in history. The S&P 500 went from around 600 at the bottom to nearly 5,000 before the next cycle began. Investors who stayed in cash missed out on one of the greatest wealth creation opportunities ever. And it's going to happen again. The Fed will cut rates, cash yields will collapse, and asset prices will rise. The only question is whether you will be positioned correctly before it happens or whether you'll be left behind. Now, I want to be very clear about what I'm not saying. I'm not saying you should panic and dump all your cash tomorrow. I'm not saying you should take reckless risk with money you cannot afford to lose. I'm not saying cash has no place in a portfolio. What I am saying is that you need to understand the trajectory of monetary policy and position your savings accordingly. So, what should you do with your cash before the Fed cuts rates? Let me share my framework for thinking about this. First, you need to understand the difference between strategic cash and idle cash. Strategic cash is money you're holding for a specific purpose. Maybe you are saving. I've always found it unsettling how easily money can lose its value, especially when it's just sitting there doing nothing. It's a silent thief, inflation, slowly eroding your purchasing power. That's why I've become so focused on the idea of idle cash, money that's just sitting in a savings account serving no real purpose. It's the kind of money that's going to get eaten alive by inflation, especially if the Federal Reserve starts cutting rates. Strategic cash is different, of course. If you're saving for a down payment or need liquidity for your business, then the certainty of having that money available outweighs any potential returns. But idle cash, that needs to be put to work. The most obvious place for it, in my view, is the stock market. I know that can scare some people, and I understand why. We all remember the crashes, the downturns, the moments when fortunes seem to vanish overnight. But I think it's important to remember what you're actually buying when you buy stocks. You're buying ownership in real businesses. These are businesses that employ people, create products and services, and generate profits. When you own stocks, you own a piece of the productive capacity of the economy. Cash, on the other hand, is just paper. It doesn't create anything. It doesn't employ anyone. It just sits there, slowly losing value. Yes, the stock market goes down sometimes. You might lose money in the short term, but if you own quality businesses at reasonable prices and hold them for the long term, you'll almost certainly come out ahead. Time horizon is key. If you need the money in 6 months, don't put it in stocks. But if you're investing for 10, 20, or 30 years, stocks are overwhelmingly likely to outperform cash. Take a company like Apple, for example. They have over 1 billion active devices in use around the world. Their services business generates over $80 billion a year in recurring revenue. They have more cash on their balance sheet than most countries have in their treasury. When you buy Apple stock, you're buying a piece of one of the greatest businesses ever created. Of course, the stock price will fluctuate. Apple will have bad quarters and good quarters, but over the long term, Apple is going to generate enormous amounts of cash and return much of that cash to shareholders. Would you rather own a piece of that wealth creation machine, or would you rather own pieces of paper that lose value every year? The same logic applies to other great businesses like Coca-Cola, which has been selling beverages for over 100 years, or American Express, which has built one of the most valuable financial services brands in the world. These businesses survive recessions, survive rate cycles, survive everything the economy throws at them. Owning them is far superior to holding cash, far superior. Now, if picking individual stocks feels too risky or complicated, you can simply buy the entire market through a low-cost index fund. When you buy an S&P 500 index fund, you're buying a piece of the 500 largest companies in America. You don't have to pick winners. You don't have to analyze balance sheets. You just own a diversified portfolio of American business. I've always thought that most investors should simply buy a low-cost S&P 500 index fund and hold it forever. Compare that to cash earning 3% that gets taxed down to 2% and then loses another 3% to inflation. You're actually losing money every year in real terms. Meanwhile, the stock market is compounding at 10%. Over 20 or 30 years, the difference between these two paths is life-changing. Let's look at the math. If you have $100,000 and it compounds at a 2% real return for 30 years, you end up with about $180,000 in today's purchasing power. But if that same $100,000 compounds at a 7% real return, which is roughly what stocks have delivered after inflation, you end up with over $760,000 in today's purchasing power. Same starting amount, same time period, completely different outcomes. I've learned one thing after investing for over 70 years. Market timing simply doesn't work. I've tried, and I can tell you, nobody can time the market consistently. Yes, stocks might seem expensive right now. Yes, we might see a correction at some point, but when will that happen? Next month, 5 years from now? And while you're waiting for that perfect entry point, you're losing precious compounding time. The data is overwhelming. Studies show that missing just the 10 best days in the stock market over a 20-year period can cut your returns in half. What's more, those best days often come right after the worst ones. If you're sitting in cash, waiting for the bottom, you'll almost certainly miss the recovery. You'll try to time your reentry perfectly, but that perfect moment may never arrive. Dollar cost averaging solves this problem. Instead of trying to predict the market, just invest a fixed amount every month, no matter what the market is doing. Sometimes you'll buy high, sometimes you'll buy low. Over time, you'll pay the average price and be fully invested for long-term compounding. Now, some of you might be thinking you're too old to invest in stocks. You're retired or close to it, and you can't afford to lose money. But life expectancy keeps increasing. If you retire at 65, you might have another 30 years ahead of you. That's a long time. You can't spend 30 years in cash watching inflation eat away at your purchasing power. You need some expo to assets that grow faster than inflation. I'm not saying retirees should put everything in stocks. A balanced approach makes sense as you age. But zero stocks and all cash is a recipe for running out of money. You need growth assets to maintain your purchasing power over a multi-decade retirement. Others might be thinking about liquidity. You want the security of knowing your money is available at a moment's notice. But most of us don't need as much liquidity as we think. Yes, you should have an emergency fund. 3 to 6 months of expenses in cash is reasonable. But beyond that, what are you keeping liquid for? Most expenses are predictable. Most emergencies can be handled with a credit card while you liquidate investments. That security blanket of excess cash is costing you a fortune in lost returns. Let me share another critical concept: opportunity cost. Every financial decision involves it. When you choose to hold cash, you're choosing not to own stocks. When you choose to own stocks, you're choosing not to hold cash. These choices have consequences that compound over time. Right now, millions of people are paying an enormous opportunity cost by holding excess cash. They feel safe seeing those dollars in their account. But they're not seeing what they're giving up, the compounding they're missing, the wealth that's slipping through their fingers. The Federal Reserve is about to make this opportunity cost even more painful. When they cut rates, cash yields will drop, but stock prices will likely rise as lower rates make future earnings more valuable. The gap between cash returns and stock returns is going to widen. The opportunity cost of holding cash is going to increase. That's why I'm saying to act now. Get out of idle cash before the Fed makes its move. Put your money to work in productive assets. Buy quality stocks or low-cost index funds. Start the compounding clock. Give yourself the best chance of building real wealth over time. I want to be absolutely clear. I'm not telling you to be reckless, to bet money you can't afford to lose, or to ignore your risk tolerance or your time horizon. Everyone's situation is different. Everyone needs to make their own decisions. What I am telling you is to think clearly about the real risks you face. The risk of the stock market going down is real, but temporary. Markets recover, they always have. The risk of inflation destroying your purchasing power is also real, and it's permanent. Money lost to inflation never comes back over long time periods. The inflation risk is far more dangerous than the market risk. I've watched inflation destroy wealth my entire life. I watched it in the 1970s when it ran above 10% for years. I watched it in the 2000s when low inflation and low interest rates quietly eroded cash savings. I'm watching it now as people sit in cash thinking they're safe while their purchasing power slowly disappears. Don't let this happen to you. Don't let the Federal Reserve's policies destroy your savings. Take action while you still have time. Get out of idle cash and put your money to work. Let me leave you with this thought. 50 years from now, your grandchildren are going to look at the financial decisions you made in your lifetime. They're going to see what you did with your savings. They're going to understand whether you built wealth or let it slip away. What story do you want them to tell? Do you want them to say that you understood how money works, that you invested wisely, that you built a foundation for generations of prosperity? Or do you want them to say that you were scared, that you hid your money under the mattress, that you let inflation eat your savings while you worried about short-term volatility? The choice is yours. But the clock is ticking. The Fed is going to cut rates, cash yields are going to collapse, and asset prices are going to move. The question is whether you'll be positioned correctly or whether you'll be left behind. I know what I'm doing with my money. I'm owning productive businesses. I'm owning assets that will grow faster than inflation. I've been putting my capital to work for over 70 years now, creating wealth instead of letting it sit idle. It's made me one of the wealthiest people on earth, not because I'm smarter and certainly not because I have special information. It's because I understand a simple truth that most people ignore. Cash is a terrible long-term investment. Productive businesses, on the other hand, are wonderful. The choice between them isn't even close. Now, I want to spend some time talking about the specific mechanics of transitioning from cash to investments, because knowing what to do is only half the battle. You also need to know how to do it. The first step is to audit your current cash holdings. Most people have no idea how much cash they actually have. They have checking accounts, savings accounts, money market funds, maybe some CDs. Add it all up. Figure out exactly how much cash you're sitting on. Then categorize that cash. How much do you need for emergencies? How much do you need for near-term planned expenses? How much is truly idle with no specific purpose? Be honest with yourself. Most people overestimate how much liquidity they need and underestimate how much idle cash they actually have. Create a plan to deploy it. I wouldn't recommend moving everything into stocks at once. That creates too much timing risk. Instead, set up a systematic investment plan. Move a fixed amount into investments every month over the next 6 to 12 months. This way, you're dollar cost averaging your entry rather than making one big bet on today's prices. Choose your investments carefully. If you're not comfortable picking individual stocks, use low-cost index funds. The S&P 500 is a great choice for most people. It gives you expo to the largest and most successful companies in America with minimal fees and minimal effort. If you want to own individual stocks, focus on quality. Look for companies with strong competitive advantages, consistent profitability, manageable debt levels, and honest, capable management. These are the businesses that will compound your wealth over decades. Don't chase hot stocks or speculative ideas. Don't try to find the next big winner. Don't buy things you don't understand. Boring is beautiful when it comes to investing. You want businesses that will still be thriving 20 years from now, not businesses that might be disrupted by next year. Set up automatic investments so you don't have to think about it. Human psychology works against us when it comes to investing. We want to wait for the perfect moment. We want to buy low and sell high. But these instincts lead us astray. Automation removes emotion from the equation. Set up automatic transfers from your checking account to your investment account. Set up automatic purchases of your chosen investments. Then forget about it and let the system work. Review your portfolio periodically, but not obsessively. Once a quarter is plenty for most people. Make your allocation still make sense. Rebalance if things have drifted too far from your targets, but don't tinker constantly. Don't react to every piece of news. Don't let short-term volatility shake you out of your long-term plan. I've been investing for over 70 years. I've seen bull markets and bear markets. I've seen interest rates at 20% and at zero. I've seen inflation high and low. Through all of it, one thing has remained constant. Owning quality businesses beats holding cash over the long term. It's not even a close call. It's one of the most reliable patterns in all of finance. Take advantage of this knowledge. Get out of cash before the Fed cuts rates. Put your money to work in productive assets. Give yourself the best chance of building real wealth. Your future self will thank you. Let me tell you a story that illustrates exactly why this matters so much. Back in the early 1980s, interest rates were at historic highs. The Federal Reserve, under Paul Volcker, had raised rates to nearly 20% to break the back of inflation. If you had money in a savings account, you were earning 15 or 16%. It felt incredible. You were getting rich just by doing nothing. But here's what most people missed. Those high rates were temporary. They were a response to a specific crisis. Once inflation was under control, rates were going to come down. And when they did, the people who had gotten comfortable with those high cash yields were in for a rude awakening. Some smart investors understood this. They recognized that when rates eventually fell, bond prices would soar and stock prices would likely rise as well. So instead of sitting in cash enjoying the high yields, they bought long-term bonds and quality stocks. When rates did fall through the 1980s and 1990s, those investors made fortunes. The people who stayed in cash saw their yields drop from 15% to 10% to 5% to eventually almost nothing. We're at a similar inflection point right now. Cash yields are elevated because the Fed raised rates to fight inflation. But those elevated yields are not permanent. They are a response to a specific situation. When the Fed decides that inflation is under control, when they decide the economy needs stimulation, rates are going to come down. The people sitting in cash are going to watch their yields evaporate, just like they did in the 80s and 90s. The difference between those who build wealth and those who watch it slip away often comes down to these inflection points. The people who recognize the turn and position themselves accordingly end up doing well. I've seen wealthy people drive themselves absolutely crazy with cash, millions sitting in bank accounts earning next to nothing, while they endlessly search for the perfect moment to invest in stocks. Years can slip by, good times are missed, dividends are ignored, and the power of compounding is completely lost, all because they couldn't bring themselves to take the plunge. The mental burden of holding too much cash is exhausting. I've seen it lead to paralysis, to endless waiting for a perfect moment that simply never arrives. When you're holding large amounts of cash, you're constantly watching, second-guessing yourself. Every dip looks like the start of a crash, and every rally makes you feel like you've missed the boat. I own stocks and companies I rarely think about selling. I own Coca-Cola, American Express, Apple, and I honestly don't care what the stock price does on any given day. I own pieces of wonderful businesses, and those businesses will continue to generate profits, whether the market rises or falls. My job is simply to own them and let time work its magic. That's the mindset I want you to adopt. Stop seeing cash as safe and stocks as risky. Start thinking of productive businesses as the safest long-term home for your capital and cash as a drag on your wealth, to be minimized except for specific needs. I know some people hold cash because they want to buy real estate, saving for a down payment on a house or investment property. Real estate does require significant cash for down payments and closing costs. But I'd say, first, be realistic about your timeline. If you're buying in the next year or two, then yes, keep that money in cash. But if it's 3, 5, or 10 years away, you're losing years of potential compounding. Consider, too, whether real estate is truly the best use of your capital. It can be a fine investment, but it's not magic. It requires management, maintenance, and it's illiquid. You can't sell a bedroom when you need cash. Often you'd be better off investing in publicly traded businesses and using the proceeds for real estate when you're truly ready. And remember, you can access home equity through mortgages. You don't need to pay all cash. In fact, given that mortgage rates are often lower than the returns available from stocks, it can make sense to put down the minimum and invest the rest. It's a more sophisticated approach, but worth considering. The key is that holding cash for years while waiting for real estate comes with a significant opportunity cost. Make your accounting for that in your plans. Let me quickly summarize. The Federal Reserve is likely to cut interest rates. This is not speculation, it's how monetary policy works. When they do, cash yields will fall dramatically. The 5% you're earning today could become 3%, 2%, or eventually almost nothing. At the same time, inflation continues to erode the purchasing power of your cash. Even at low rates of 2% or 3%, you're losing ground every year after taxes and inflation. Cash is almost always a losing investment over the long term. The solution is to get your idle cash working in productive assets before the Fed makes its move. Buy quality stocks, low-cost index funds, own pieces of real businesses that generate real profits. Let compound interest work for you, not against you. Don't wait for the perfect moment. Don't try to time the market. And don't let fear of short-term volatility prevent you from building long-term wealth. Start today. Set up automatic investments. Be patient, disciplined, and consistent. The next decade will separate the wealth builders from the wealth losers. Those who understand monetary policy, inflation, and the power of owning productive businesses will thrive. I've seen this movie before. After every interest rate cycle, the ending is always the same. Savers get punished and investors get rewarded. The only question is, which group will you be in? I know which group I'm in. I've been investing in productive businesses for over 70 years. I've never regretted owning quality companies, but I have often regretted holding too much cash. Learn from my experience. Get out of cash before the Fed cuts rates. Your financial future is at stake. The time to act is now. One final thought. I understand that change is hard. Moving from the safety of cash to the volatility of stocks feels risky. You worked hard for your money and don't want to lose it. These feelings are natural and valid, but consider this. The biggest risk you face isn't losing money in a market decline. Markets decline and then they recover. The biggest risk is not having enough money when you need it, not having enough to retire comfortably or to handle emergencies. After 70 years of experience, I can tell you what I know. Cash feels safe, doesn't it? But it doesn't grow. Productive businesses might feel risky, but they compound your wealth over time. And over any reasonable time horizon, that compounding wins. It always has, and I believe it always will. The Federal Reserve is about to act, or so it seems. The real question is whether you will act first. This is what has worked for me and for every successful investor I have ever known. Cash, in many ways, is a trap. Productive businesses are the path to wealth. The choice, of course, is yours. Choose wisely and choose soon because the clock is ticking and the Fed is about to move. I urge you to consider this carefully.